Hello, everybody. Welcome to Friday, another Talk Money with Tom show. This is our last show for the year, actually, from our digital studio that we created this year. I'll just show you again just something that we do here. So this is what the actual studio looks like. And, of course, we've got this broadcast of this beautiful set that we have here that we use, from San Jose and what have you. It's a digital set. So really appreciate that you've been able to join us this year. We've been able to answer questions. We're trying to help people, move along in their education on really improving their retirement. And we talk about asset management. We talk about retirement planning, tax planning, those types of things. So feel free to send in questions. Send them in today, and we'll try to answer them live. So you can send them an email at asktom@talkmoneywithtom.com, or you can put them into chat, whatever works better for you. Go ahead and try that, and we'd be happy to answer that. We have questions that were already sent in this week. We have situations that we discussed with clients that we often bring up here too. So hopefully we can really make this work for you. We do have this channel, talkmoneywithtom.com. Got over 1,000 videos on here now. And so if you want to subscribe and push the little bell, you can get notified when we put new things on there. Our objective is to try to help you move along in your education. Even if you have an advisor like my clients do, I still think it's easier when they are farther along and kind of understanding what I'm talking about. And that's really the genesis of this show. And of course, if you want to meet with Eason and I, you can do that. Just go to our website. There's a link right on the page here. Go up to the corner. You'll see a book appointment button. Looks just like that yellow button there. And just pick out a 30-minute, video or phone time to meet with Eason and I to really kind of go over your personal situation and things that you might want to have us help you with and what have you. So really looking forward to today's show. Our objective here is to try to hopefully find one thing at least that you can grab onto to try to improve your situation. So look forward to that. Of course, for those of you who've been watching the show for a while, you know that we start off the show with a weekly market summary and really just talking about what we saw in the market. Asset management is one piece of a retirement program, right? So even if you're not retired yet, the more you can learn about asset management, the better, because a lot of the incomes and what have you that you might be generating is going to come off of your investments. And so, we have other things like pension and Social Security and rents and what have you, but then you're going to be saving money, hopefully, and now you've got to have somebody manage it, or you manage it, or whatever the situation. Irregardless, it's better to understand what's happening. And so you can see here, this is the year-to-date chart for the S&P 500, and that red line across there is kind of connecting the peaks that we've had. We've now had quite a few. The very peak for the market was back on January 3rd or 4th. And obviously we've had the very low is right here over my shoulder, and that's October 12th. So 28% drop, right? We're in a down market as defined by classical definitions, in the sense that the peaks are lower on each one of these, run-ups, and even the troughs, the bottom portions here are lower also. We're hoping to try to get a new trend established to the upside here. But we just had a failure this week on Tuesday. You can see if you look closely, we touched the red line. Mm-hmm. We did get above the 200-day moving average a couple times over the last couple weeks. That's actually a big deal, but it didn't hold. We kind of fell below that. So this week we had some crazy things happening, I think, that are really important to understand. Number one is we had the inflation report that came out. Everybody thought it was going to be about 7.3% to 7.5, somewhere in that range. Came out at 7.1, so that's fantastic. Mm-hmm. Really good situation, because we need inflation to keep coming down. And it was better on the core inflation. It was better on year over year. It was better on month over month, all better than expectations. So the market was hanging in there, and that's when we really touched that trend line. Unfortunately, the next day, the Federal Reserve met. And so their objective, in my opinion, is to try to make sure that the stock market doesn't go running off to the upside. Mm-hmm. Because they have a thing called financial conditions. So they'd like to see financial conditions tighten in this environment, so that basically there's less money floating around that can push inflation. So if they can talk the market down, that actually helps them along with all their other tools. So yeah, they came out and said, we're going to raise rates more than we said last quarter for the terminal rate. We're going to probably keep them up all the way through 2023. And the market responded negatively to that. Not dramatically.
No, it wasn't a big movement.
Yeah, but yeah, definitely, there was, kind of a hangover there. Then we had, Europe and all these other central banks basically the next day, Thursday, come out with their rate increases, all 0.5% for the most part, as far as that goes. And so we had a pretty bad day yesterday. And the combination of kind of what the Fed was saying, on Wednesday and what happened in Europe, but then also there was a retail sales report that came out that was worse than expected. And so, of course, this brings on the fear of recessionary situation because the consumer is the one hope we have of being able to kind of soften that recession as far as that goes. And now, the other thing to keep in mind this week that's very important to understand, you can see it's quite a dramatic drop from that high point with those red boxes. But we have quadruple witching day today, right? So I know that sounds interesting, but what it is the expiration of options and futures contracts. And oftentimes the market gets very volatile and usually actually ends up going down both the day before, which is yesterday, and today. So I would be a little careful of drawing too many conclusions from these downturns. Let's wait and see what happens on Monday before we get too worried about what's going on as far as that goes. And so I have another really key point that I've been trying to make to the clients here all along, and this is a little hard to see, but what we have here, this is the SPDR S&P 500 ETF.
Mm-hmm.
The ticker symbol is SPY. And going back to 2010, right? And so if you look, I've got a blue line there kind of running all the way through, all the way up until today. And what that blue line is called a regression line. And so it's the average of the prices up until the pandemic.
Yep.
And I just continued it past there. That blue line, the angle is 14 degrees. So basically the market was marching along at kind of a 14-degree upward angle.
Kind of like a steady, easy hike up.
Yeah, and you could tell it wasn't always up or down. There's a little variation around that line. Basically the stock market is a representation of human emotion, so it's never a perfectly straight line, right? Because it's human emotion. But then the pandemic hit, and you can see that big drop there, right? Kind of that cliff, fastest 35% drop in history. And the governments came out and they flooded the markets with money and quantitative easing and lowering of interest rates down to zero or even negative in some of the European countries. And you see, and I've drawn a little orange line through there. It's a 54-degree ramp up from the bottom of that pandemic to the top of the market that ended up, very beginning of this year. And so if you think about that, that's not sustainable.
No.
Right? And so I'm having clients conversations and they're like, oh, we've lost so much money. And they're right if we look at that top point, right? But what's really fascinating is that it's not, in my opinion, so much that we've all lost so much money from that high point. It's that we temporarily got more money on our statements than we probably should have had, caused by the pandemic.
Yeah.
That's a pretty interesting thought. Think about that for a minute. No pandemic, we're still on that blue line. And actually, if we were still on that blue line, all of us would probably have even less money on our statements right now, because we're still slightly above that, than we actually do. And we wouldn't be unhappy with it either, because if we still had marched along on that blue line, we're still growing at this 14-degree, positive slope, and we're okay, things are going all right, we're doing fine. It's just because we had a pandemic, they pushed out so much money, it drove the market up at a 54-degree angle, non-sustainable, created high inflation. Now they got to pull that money back. And they do that all kinds of different ways. They do that by, doing quantitative tightening for the Federal Reserve here, for example, and of course raising interest rates. And we've had a pretty decent amount of interest rate increase this year. So we're coming back down, I think, to kind of some normal. Now, of course, life is not a straight line. We might not quite get to that line. We might go below it. We'll have to wait and see. But I just think mentally it helps a little bit to kind of understand that it isn't so much that we've lost money. It's the kind of the opposite of that is that we had more money than we should have had temporarily. Now, some people got out at the top, right? And pulled money out and did different things. And we actually sold a bunch of things that did really well in that run up to there at the beginning of this year, for example, that turned out to be good things to sell. But nonetheless, it's very hard to kind of say, capture all your money. I'm getting everything out at this top.
Yep.
And, that doesn't happen very often. And so I think this is a really helpful thought process for people to kind of understand what's going on and that we're just kind of going through this scenario. And again, we might actually have less money than we have now, even though we feel like we've lost so much. But we might actually have less money if we wouldn't have had a pandemic.
Yeah, would you say this is kind of similar to that 2000 bubble that we had where,
Yeah.
things got inflated out of control and it kind of popped and came back down?
Yeah, the best 5 years in the history of the stock market is 1995 to 2000 for rate of return. And if you think about what happened then, see, in 2000 we had this Y2K, right, the Y2K bug, and tons of concerns about that bug. Computers are going to crash, planes are going to fall out of the sky, cars are going to stop on the freeway, all of these things. And so the Federal Reserve started pumping money into the system and pumping and pumping. And if you look at where that peaked out and where it started to fall, the Fed started pulling that money back in 2000. So we started seeing big drops February and April of 2000, June of 2000. And that's the same thing. They just overpumped things to get that going. We didn't actually have all of those crazy things happening for the Y2K, but nonetheless, the Fed was overinflating, big bubble, same craziness too. These dot-coms, companies with no earnings, companies with no revenues, companies that didn't really have a product that were going crazy, very similar to what we saw here. Companies like Rivian, went public, didn't even have a truck that they'd made yet. They were worth more than Ford, I believe, at one point. There was many of these stories. And so it's the same thing. It's too much money. Now, here's the good thing about this. Eventually, we're going to get back down. And the markets generally will be more, I think, evenly allocated. We won't be spending money on crazy things like these IPOs. That money will be going into companies that are doing real things. And so I really feel like there'll be a quality component that really does well here, maybe value stocks or really, high cash flow stocks and what those types of things, because, everybody's gotten burned on the SPACs and the IPOs and all these crazy things. They're all down, 50 to 90%. And so now they start to look at the real companies that do well, and that money gets reallocated. Well, cryptocurrency. So there's another crazy, right? Which was, what was that, 3 trillion? Now it's 800 billion or something in that neighborhood. And so that's just part of the bubble. That's kind of the same things we saw in 2000, right? So yeah, it's very much so. This is very much so like that. Too much money pumped out, being taken back, creating a big downturn, right? So I guess one difference, though, that we have here is that in 2000, by this point, we had a lot more unemployment because there was a kind of implosion of all those dot-com companies that we haven't seen yet. And we didn't have pent-up demand from a pandemic where everybody had to stay, in their homes or what have you for some period of time, that are now really excited to get out and do things, right? So that might help us to have less of a downturn, because 47%, 45%, one of those two was the downturn from peak to trough in the 2000. We're currently at 28% from peak to trough. I don't know, we might go lower than that, but we might not go to 47, just because this is a little bit of a different situation in that businesses are fairly healthy in terms of where they're at. Banks are healthy, which is important. That created a big problem in 2008. And consumers are actually fairly healthy too, as a whole, right? So, and so maybe we have a softer landing here than we do in some of those others. I want to just continue to talk about the fact that even though the stock market is dropping right now, we're seeing a decrease in the yield on the 2-year Treasury, okay? So the Federal Reserve comes out and says, hey, we're going to raise rates even more, and the 2-year Treasury goes down. That's not what's supposed to happen. So what's happening is the Federal Reserve is saying, hey, we're going to go up to this rate, and the 2-year Treasury in the bond market is saying, no, you're not. And guess who's been right so far? So September of last year, they said they weren't going to raise rates at all in 2020. Oh, wow. 4+% rate increases for 2022. For 2022. And now they're saying, okay, we're going to raise rates to this higher level, 5.1% terminal rate. The futures market now says 4.8%. Futures market's been right, Fed's been wrong. And they're also saying that they're not going to decrease rates at all. Most likely, Chairman Powell said in the question and answer session, probably not going to be lowering rates next year. Those are things that drive the market down because the market actually kind of thinks, okay, if they do that, they're going to make a mistake. Because the overall futures market is showing rate cuts in the second half of 2023 right now. And that's been true for that futures market for quite some time. And so the reason that these things would be coming down is because the economy softens so quickly that they're having to actually back up and say, wait a minute, we need to take some of this increase in rates off the table and come back down a little bit to keep us out of a big recession as far as that goes. I think the other thing that's happening is that inflation is probably going to fall faster than people think. Rents are a big part of core inflation, and rents are a lagging indicator. If you look at current rents that are being paid for, they're much lower than rents that are currently in the CPI, and we'd already be back down quite a bit if we had those rents, and we're going to have those rents. They'll be in the report. Wages are actually falling in terms of the increase that's coming down faster than we currently have, right? We saw that last week when we talked about the Indeed. You look at current jobs versus, that are being offered versus current jobs that people are working in. So there's some significant things showing inflation's going to be coming down, but I do think the focus is now shifting to recession, right? And how bad that's going to be. And so what we saw was a report for the retail sales that really got this downturn that we're in now, Thursday and Friday, started. Again, it's quadruple witching time, so it doesn't take much to get it going down. But the report was that this retail sales dropped 0.6% in November, right? Expectation was 0.3, so it's a big difference. But the report, if you dig into it, is geared towards goods. Things that you can buy on Amazon, cars and refrigerators and all those type of things. And so we showed you this chart last week, which I want to reiterate. Number one is overall total consumer spending is doing pretty well. It's continuing to move up. But if you look at the blue line there, that's goods. See how it's topped out.
Yeah, it's stagnating.
Right? But even in this report that came out on Thursday, the service, there's only one service part in this report. Not a great report, but the market responded to it. But the service portion in there was restaurant and bar sales are up 1%. And so we can see it. If we look at this yellow line here, services are still growing.
Yeah, next week we'll have another kind of retail report that's a little bit more geared towards service.
Yeah, it's at least balanced. And I think that's the key thing here. And so this is very fascinating because what's happening is it makes sense, right? We were all stuck in our homes. We could order goods, and so we did. And we redid our homes, we redid our yards, we bought, Pelotons and whatever we had to buy. And, I saw on the way here to work today, there was one of the exercise machines, so an elliptical trainer just right out on the sidewalk or, right next to the sidewalk with a free sign on it, right? So somebody's trying to get rid of something they probably got during the pandemic. And we're now spending that money on restaurants and bars and hotels and airline flights and what have you. And so what is happening, if you think about it, we've gone from a situation where, the supply chain issues were China shipping. Remember all the ships, outside the port of LA backed up and what have you, to now services, which needs labor. And so the tightness is in labor. And so we are continuing to see pretty good reports about labor, including this week. The first-time unemployments were 20,000 applications, less than expected, right? So labor is still good. Wage growth is still happening. Maybe it's going to slow down some, but it's still happening. And so those are good things that might be able to kind of help us in terms of the recession side. And so we got to focus on what is really going at any point in time. And again, we're coming out of a pandemic, hopefully. And really, it's different. This is not the same as normal, situation. This isn't going to be a normal recession. This hasn't been a normal downturn. This hasn't been a normal bubble. All of this is different, and so we got to kind of, analyze that. Just quickly, again, we showed this last week. I think this is super important. 2 quick points. Number one is the average rate of return for a recession while it is happening. Declared recession to the end of the recession, was negative 1.5%. Pretty big range, right? Negative 35% in the 2008. In order to get these big negatives, something has to break, in my opinion. And what could that be here? Honestly, if you know what it is, it's probably not what it is, because it's the things that you don't expect that cause the biggest scary things that happen in the market. If you look at the last bubble that we had in 2000, right, the market was down 7.2%. So that's a little bit like this. If you look back to, what happened in the high inflationary periods, we've got a couple of them in there. 73, it was down 18, but 80, which is another high inflation, was up 16, it was up 14 and 81. So, if something doesn't break, we might not have a terrible scenario during the recession as it's happening. And again, we're dealing with a pandemic here. And then again, I want to show you this chart because this is, again, too many numbers here. But just to make a point, this shows for the last, since 1957, we've had 9 recessions. If you look at what happened once those recessions started to come to an end and after them. So the first column here shows the S&P 500 return 3 months before the end of the recession. It's up 12.9% on average. That's really good. Actually, I'd take that in a 3-month basis.
Yep.
Yeah, it'd be great. 1 year after, it's up 15.1%. 3 years after, it's up 40.1%, and 78% on a 5-year basis. So we might have some pain between now and the start of this recession, but once we get towards the end of this recession, if it does happen, things will start to get better. And this is, historically anyway, this is the silver lining in all this. Now, here's something else to notice. If you look at this, this is a 9x4 square, right? 36 data points altogether, not including the totals. Out of those 36, they have positive rates of return in every single one of them except for one. So very high probability that we will have positive rates of return when we get towards the end of the recession and then after, right? So that's what we're kind of waiting for, and that's what's happening right now. I wouldn't be too concerned about what's going on with the downturn that's happening here. Let's see what happens next week. December is generally a good month. Matter of fact, it's the best month. So hopefully we see some rally coming out of this kind of, I think, maybe overstretched downturn that's caused at least somewhat by this quadruple witching hour. If we don't, then we'll get more conservative with our allocations. We currently have 3/4 of our stock market exposure in. We'd probably cut that back and just wait through this downturn that might happen. You do have to be careful. You can look at things and say, hey, the treasury yields are doing this and this is all, and so the market should be going this other direction. But you got to pay attention to the price. It's called don't fight the tape. Right? And so, we'll move with the tape if we have to. But I do think things can kind of settle in here. We're really going to be paying a lot of attention to earnings next year, especially that first quarter, to see if this recession concepts and these higher inflation and higher interest rates are going to have much impact on earnings for the companies that are out there. So anyway, good time frame to be watching the market, and kind of a lot of things that we can learn here too. So. All right, so good. We covered all the summary pieces. Let's talk about some of the questions. What do we have first for questions?
When should I take my RMD next year? Should I be trying to time the market with my RMDs? Like, if we're going to have a recession, should I be taking it in the beginning of the year?
Yeah, so theoretically, this year, if you look at the chart, we hit the peak of the market on the 3rd or 4th of January. Can't remember which one it was. And that would have been a pretty good time to kind of cash some money out of your IRAs and pay out the RMD, just because you would have been selling some shares at high price. Yeah. And however, that's hindsight. Hindsight's undefeated.
Yeah, 2020.
It works pretty well. Unfortunately, we don't have that, and we don't have time machine. We don't have anything that can really help us there. So what I look at is kind of just probabilities, right? What's the probability? And so here's something I'll share with you. We have a slide for that, of course. This is a good question. So this comes from Vanguard, and this is a historical return going back really far, which I love, 1926 to 2019. And they've cobbled together, and you can see the fine print here, all of these different indexes to kind of create this, average rate of return, which for a 100% stack portfolio was 10.3%. So that's the average. The best year was 1933. It was up 54%. Wow, that's a big one. That's during the Great Depression. The worst one, of course, was just a few years before that, where it was down 43%, right? But here's what I would look at for the RMD. Years with a loss. So 94 years in here. 26 of them was a losing year. During those 26 years, theoretically, you probably would have been better off taking your RMD earlier than later, right? But that's only 27%. So if you're going to play the odds, 73% of the time, the market went up and had a positive rate of return. And so the reason to kind of take your RMDs, in my opinion, at the end of the year, if you can, if you need them earlier, take them. That's okay. Yeah. Is that if I have to take out 10,000 and the market makes 10%, right, which is the average in this case, I might have 11,000 for that 10,000 at the end. I take out 10, the other 1,000 gets to stay in my IRA and grow. If I take it out at the beginning of the year, I don't get that extra $1,000 in my IRA for growth because I've basically lost that compounding. So, I don't know, investing is at least somewhat, if not a lot, odds and playing odds and probabilities. So for me, when I look at RMD timing, I definitely consider this. On average, right, or more, 73% of the time, so the last of that 94-year period, the market had a positive rate of return. I think that's pretty good way to look at it personally. Yeah?
Yep.
All right.
Should we expect any end-of-year rallies in the last 2 weeks of the year, the last couple weeks?
Yeah. Well, I have a model that kind of measures stretch for the market. And so when it gets to -5, it's stretched very high to the upside, right? And the chances of it going up and up and up past that point, it's harder because, again, if you take a rubber band and you stretch it, you can stretch it pretty far, but at some point in time, the resistance gets to be really, really hard, all right? And so it's the same thing going the other direction. So if things are really, really good, I have a +5 number. And today we hit 4. So not 5, but 4. And so what that means is that the market in this big downturn we've had, this week really, is stretched to the downside fairly substantially, right? And I wouldn't say it's like really low. Again, it's not a 5. But we have, and I have a slide here for this too, we do have a seasonality at play here. So we have a big stretch right now. Here, what's the 16th of December? And December is the best month of the year. So if you look at that dark blue line, the Dow, the line next to it is the S&P 500. That's the highest rate of return. Even the Russell 2000, the small cap index, the green line there at the back of that column is, obviously the highest. So we have the seasonality for the end of the year combined with this stretch to the downside. We could get a bounce, and so there is an opposing force to the upside that could create an end-of-the-year rally here. So we'll see. I think we were talking about this before, and you were saying there's also just not a lot happening.
Yeah, there's not a lot of economic reports or any kind of data coming out.
Yeah, you don't have the Federal Reserve coming out scaring the market, and they don't have a chance because they don't meet again until at very end of January, beginning of February. And so we kind of have this little vacuum. There is a retail sales report that comes out that you talked about earlier next week that could be, important because, again, the market is shifting its focus to possible recession and how steep that recession might be. Retail and consumer behavior will be a big piece of that concern as far as that goes. But, yeah, we could see a rally coming out of the end of the year just because we are stretched to the downside, could get some buying that comes in because of that. There's an awful lot of people. Now, the one thing that'll probably keep us from part of that rally is that we have this trend line coming down. And so we just touched that on Tuesday and whoosh, came down. And so and it's still coming down. And so if we have a rally, we're still going to run into that downward trend line. And it's obvious that there are a bunch of institutions selling at that trend line. And so, maybe that blunts the rally, or we actually break through it. And what will happen is there's a bunch of institutions that are probably on the other side of that trend line that are going to buy, and that could drive it. And you generally get a little bit lighter volume, so you can see more motion one way or another. So I think that's going to be very fascinating to see how this plays out, whether or not we can challenge that trend line, or whether we completely, ignore this seasonality and kind of fall, throughout the time frame. So it's possible as far as that goes. We'll see. All right. What's the next question?
What is sector investing?
Sector investing. So essentially, what happens is, there's lots of different ways to invest. And, generally speaking, for us, we will put 76% on average, of our allocation to the broad market, S&P 500, total stock market index, those type of things. And then we have these targeted indexes, and oftentimes we'll buy sectors of the market, And so, because, for example, with the Vanguard Total Stock Market Index, VTI, I think it's 4,500 stocks in there now.
Yeah, it's quite big.
If you own that, you own everything in the U.S., and so then if you go buy another sector, you're basically just overweighting that section because you already own it, as far as that goes. And so, but one of the things you look for is, hey, this sector's fallen more and I want to buy it now, or this sector's really on a run and I want to buy it now, and you're trying to use a little bit of that to try to enhance returns and such too. And so I have a slide to kind of show you for this too, just to give you an example. This comes from Vanguard. This is their kind of sector ETFs, right? And so what they're doing here is, if you look, that top line there is the entire, investable market through MSCI, which is the 2,500 index, and you can see information technology and financials and healthcare and consumer discretionary industrials. And so in this case, I think there's 11, as I recall. And so, that might be, when you talk about sector investing, you might be picking that. One of the ones that's doing quite well right now is healthcare, VHT, right? So it has had a counter trend here, come down a little bit, but a lot less than the market. And so there's some strength in that sector. And so some people might be buying that sector based on that strength, right? And obviously one of the things that's happening is because of the flu season and all, there's a lot of activity going on in healthcare centers right now, which theoretically generates revenue for them as far as that goes. So, that's an area where we're seeing some over motion. And then the other one down there, VDE, energy. That's the one piece that's gone up the most this year, right? Even though the market's down, that's positive. And so again, you might have energy as part of your portfolio. Energy is already part of the overall market. You already own it, but maybe you overweight it as far as that goes. Has come down a bit here recently, so we'll see where that goes. But that sector, investing as a whole is just kind of this piece. It's something, we look at all the time. We were looking at these different sectors and trying to figure out what to do.
Yeah, and there's some ETFs that are basically, they take all the sectors and then they pick 3 or 4 and they say, during this time period or this business cycle, we believe these will outperform the other sectors, so we're going to overweight them. And so that's a way that some people try and, add to their returns.
Which is basically what we do as a practice. Yeah, so what they've done is they package that into an ETF. And it's kind of a cool concept. There's some validity to it, because not every sector of the stock market is doing spectacular all at once. I mean, there tends to be some that are really lagging behind, and if you could kind of focus on those that might do well going forward. The problem is it's very difficult to tell which ones are going to do well. It's why we have 76% of the money in the broad market and just the other 24% of our stock market allocation in these sector targeted areas. And you can break these down different ways too. This is just what we call kind of a normal sector, but it could be clean energy, it could be genomics, it could be innovative technology. There's a bunch of different ETFs that are sectors of the stock market that you can buy because you think they're going to do well, you like them, they have a great future, whatever it is. And again, if you already own VTI like we do, you already own all those stocks. But that's the idea behind investing in sectors, is to kind of overweight those. All right.
Should I be getting back into bonds? The Fed seems to be slowing interest rate hikes, or we're just keeping it flat. So is this the time to try to dive back in?
Okay, if you think about bonds, what makes bonds go down? What makes bonds go up? And it's a little bit easier than stocks to a certain degree. So number one thing that makes bonds go down is interest rates going up. No doubt about it. So the Federal Reserve is still talking about raising rates, right? And their summary economic projection, they're talking about 5.1%. Right now we're about 1% away from that, give or take. And so we're still going to look at raising rates. However, the markets are always ahead of what actually happens. Mm-hmm. And so that's a valid argument. The Federal Reserve is already talking about some peak rate that they want to get to and want to keep it there. The futures market is showing that their Federal Reserve will be lowering those rates in the second half of next year. The bond market is going to move well before those lowerings happen. It might go a lot faster once they start lowering, but the market is a betting mechanism on the future. And so we're already seeing some motion in the bond market. Let me show you a chart. We have charts for everything. All right, so this is the Vanguard Total Bond Market Index, and this is what BND is, the ticker symbol. So the green line is the price. I kind of drew a red line in there for the trend from that one elbow down. That's a pretty dramatic drop actually for bond funds. This was I saw a study on the 10-year Treasury, which has a really long track record. This was the worst 10-year Treasury market since 1788. That's pretty incredible. And it's because they've been raising rates so quickly after lowering them so much to stave off the pandemic, depression that would have happened. And so that blue line in there that's kind of wandering, that's the 200-day moving average. So when you look at that, we did hit a bottom here, and really back in October. We've had a nice bounce. We broke this one trend line. I like that. We actually added to bonds this week. We bought both the Vanguard foreign bond, and we bought this BND index also. And we still have a large portion of our bond holdings sitting in T-bills outside the bond market. I'd like to see some more proof here, because that trend line that it broke, the steeper the trend line, the easier it is to break, and the more likely that it won't hold, right? So that's a very steep trend line, but still important, because the other thing that factors in that would make the bond market go up is a softening economy, which is what everybody's now afraid of, a recession. During recessions, the Federal Reserve is lowering interest rates. There is a flight to quality. Generally, treasuries might do well, those types of things. And you can see bonds do well. So we have two things going on here. Inflation is falling. It seems like at a fast enough rate for the Federal Reserve to at least talk about a peak that might be not too far from where we are, and then pausing that peak. And then secondly, we're looking at some numbers that are showing recessions and all kinds of inversions and things that are happening, which would be good for the bond market. So I do like the bond market. I do believe in this scenario that the bonds will lead us out of this scenario. And even some of the more crazier bond things like the 20-year plus type treasury pieces might be a good play inside of that kind of stock market portion of your portfolio. They tend to have a similar standard deviation to the overall market. So it's not a normal bond, but if you want to play the bond market in a more aggressive standpoint, you might have 3% or 5% or something in something like the Vanguard Extended Duration Treasury, which is EDV, has a standard deviation pretty much the same as the Vanguard Total Stock Market. But it's had a nice run here also. It bottomed out at roughly the same time. So I wouldn't call that a bond portion of our portfolio. I'd actually replace some stock pieces, only because, again, I think bonds will run first here. They'll be the things that kind of come out of this, in my opinion, faster than the stock market. So, yeah, it's worth taking a look at. Now, we're not through the 200-day moving average. You can see that blue line. And so, if you really want to be careful, you might wait until that happens. And if you really want to be careful, you see where that red line is touching the trend here, where it's touching the green line up above where we are. That's the last peak. And if you look at kind of Dow theory, reversal of trend, part of that is to get to a new high. We get above that 200-day moving average, through that trend line, and above that last high, you've got a kind of a sweet spot there where bonds might have a decent chance of having a run. So it's a ways from now. So it depends on how aggressive you are, as to how you want to play this. But yeah, I think bonds are interesting in this environment and something worth taking a look at.
So,
all right.
what are some pros and cons to a senior community or a 55 and plus community?
Yeah, I actually have a lot of conversations about this with the clients over the years, and I find it kind of interesting. We have a lot of clients in these facilities, so we get to meet with them and talk to them and find out what they like and don't like about it. And so, it's interesting to hear. It's kind of an opinion-based scenario. And some people want nothing to do with it, and some people are super excited about it, right? And so the pros, as far as I'm hearing from the clients and as far as I've learned over the years, is just that, there's like a community. And, you might have lived in this house by yourself, and now all of a sudden there's like 100 people around you to do stuff with. And they have games, they play bridge, they go on outings, and I've had clients that are just like revitalized. They're super excited that there's so many people to talk to. And again, it depends on what you really like. And they love that aspect of it. And of course, in terms of your health and your care, depending on the facility, they might have, you go from independent to assisted to long-term care to possibly memory care, those type of things. It's kind of nice. You're in one spot. They take care of you. Maybe you just need help remembering to take your medicines, and they might be able to have that. Depends on the facility, right? So people like that. They just want to know, hey, I don't have to move again. I'm here. I'm taken care of. I'm not going to be a burden on my kids who are now coming over to try to help me with my medicines, or whatever it might be. And so I think those are the things that people really like about it. They're not having to take care of a house and replace a roof and all of these things that are kind of, difficult to deal with long term, right? On the con side, the things that I hear about, of course, they're very expensive.
Yeah, they're not cheap.
Yeah, and they generally continue to increase the fees. I'd say 5% is what I've seen with almost everybody, 3 to 5 for sure. But this year, I'd say 10 to 11 is what I'm hearing. So that's a huge jump. You're already spending thousands of dollars a month, and then all of a sudden you've got this 10 to 11% jump. And so that can be really expensive. And so hopefully you had some money coming into the scenario to make that work. So that's one thing that kind of sometimes propels people away from those in the first place, and sometimes kind of bothers people that are in the places, just this cost and now these kind of increases that are coming through. The other thing I hear most often is, I don't want to be around a bunch of old people. And this is from an older person, of course, but, they just feel that vibrancy that happens with, other age groups that are there, and whatnot too. And so they don't want to be around a bunch of people, that are older and kind of a defined group like that. Now, again, some people love that. I think that's perfect. And other people don't. So, again, I'm not saying what's good, bad, or different. I'm just telling you kind of what I heard from my clients over the years, just to give you some ideas of what we see out there. And of course, then there's just, a plethora of different places all over the country. Do you do it here? Do you move someplace else? Do you, what are the facilities like? Do they have the different levels of care or not? Do you have to buy in, right? If you do have to buy in, is there anything that you can get out of it as a beneficiary or not? Does it all disappear? There's some where, basically once you run out of money, they continue to pay your bill, right?
Yep.
And there's others where they don't. And so, there's a whole variety of different types out there in terms of, where you might end up and how that might work. So anyway, it's an area that we've had lots of conversations with clients about over the years.
Yeah, and one thing is when you get to kind of like these senior communities is you become kind of more homogenous in your demographic.
Yeah.
And so sometimes, you know, you lose that, you know, different thoughts, you know, different people.
Yeah.
A lot of times because of just the cost, it becomes your very social economics are also very similar too.
Yeah, yeah, that's right. That's right. Exactly right. You're not gonna, I mean, you need enough money to be in there, and that does cut off a group of people that you no longer would have as much contact with. And again, for some people, they think that's a good thing, and other people, they really love just the variety of different people that they, get to interact with for different situations. So again, it's just it's important to understand who you are, what you would find to be, useful, and then kind of go from there. So yeah, not bad. All right, that's our show for today. Really appreciate you coming again. As I mentioned at the beginning of the show, this is our last show for the year. We're taking a holiday for the rest here, the next 2 Fridays. We will be back on Friday, I think it's January 6th is the Friday, first Friday of the year. We'll be back with our show. Feel free to send in questions, even during the holiday. We'll look at them next year and craft some nice, answers to those and try to help you out. So look forward to being able to help you out again next year. And I thank everybody that has watched us this year, and look forward to being able to help you again next year. Thank you very much. All right. Well, that's good.